Good morning, everyone. Welcome to Daily Rates Live with the Mortgage Calculator. My name is Hershey. I am the president here. But we have over 200 loan officers here at the Mortgage Calculator, licensed in over 20 states, that would be happy to quote any of our customers out there for any of the options we go over today. So what we do every day is go over the markets in general. A lot of news today. A pretty crazy day for the markets. And then we'll see what that means for live rates. We'll pull up our live rates this morning for some of our standard loan programs. And then we're going to talk about something unique here. So we always deep dive into a specific topic. Today we'll be talking about non-warrantable condos. Definitely a hot topic, especially here in Florida where I am. So we'll actually use a Florida example. A little bit more restrictive in Florida, but definitely one of the most requested items there. So let me go ahead and switch my screen here, and we'll check out the markets today. So we typically want to look at, when we look at rates overall, is the 10-year Treasury. These are going to track with mortgage rates, especially when we're comparing all kinds of different programs. We're going to see the general markets overall react with the 10-year Treasury yield. So here you see in the last just couple hours, rates have skyrocketed. So not so great news, but we always want to calm the panic here and pull out 1 year. We're still at 1 year lows. We just weren't quite as low as we were the other day. And if you put this into 5 years, of course, we are far off from where we were. But it is a good time to be out there shopping. And hopefully the news calms down a little bit today and we see a more standard option here. Now let's check out what this means for the live mortgage rate. So I just refreshed this page. That way we could pull up the rates today. So they did go down a little bit yesterday. Went back up this morning. And obviously the rates changed. So here we have all of our different programs. We'll compare side by side using a standard scenario so that we can see the lowest rate options. We'll do a 1-unit single-family home, $500,000 purchase price, $300,000 loan amount. That's 60% loan to value, 760 credit score estimate, and estimated 40% debt-to-income ratio here. That way we can compare all the different programs side by side and the lowest rates for all of them. So the lowest rate option here for a conventional primary home, still holding on barely, under 6% there for a standard 30-year fix. Rates as low as 5.999. And the final APR there, when you add in all the fees, 6.273. About the same as it was yesterday. Not too much panic yet this morning. No reason to panic. And we have our FHA options. If our customer doesn't qualify for conventional, we typically want to compare FHA. It allows a little more leniency on credit issues, a little higher debt-to-income ratio, but does have upfront and yearly mortgage insurance. So you see here the rates as low as 5.375, so it appears lower rate. But when you add in all the fees and the mortgage insurance, you're at 6.282 APR there. That's why we use APR to compare apples to apples across the programs. And for our VA eligible borrowers, VA programs are amazing. Coming in at 5.5 rate today, lowest rate option. Final APR there, 5.766. Much lower fees for our VA eligible borrowers. So as you can see there, typically always going to be the best option for our eligible vets. And for USDA, those properties in USDA rural areas of the country, coming in today, 5.375 rate, final APR 6.046. So if the property is eligible, the borrower is eligible. It's a touch cheaper than FHA and conventional. So if our customer is comparing, USDA may be the best option. And our unique options here under non-QM. So this is where Mortgage Calculator team loves to shine. We have all kinds of non-QM options where we can use alternative docs. So if our customer doesn't qualify for any of the standard options here, we can use alternative docs such as bank statements, 1099s, P&Ls. Very helpful for our self-employed borrowers. And for a primary home here, rates as low as 6%, final APR 6.272. And today is a great day. We love on this show when non-QM is cheaper on the final APR here than conventional. Absolutely amazing. So even though the rate seems a touch higher, the costs are a touch lower there. 6.272 for non-QM alt doc, 6.273 for conventional. Conventional does react with the markets there very quickly. Non-QM doesn't react as quickly. So pretty amazing there. And our alt doc option for investment property, 6.125 rate, lowest rate option, final APR 6.448. And we'll compare that to conventional for an investment property. Coming in today, same rate, 6.125. Final APR 6.438. Almost identical, just a touch cheaper. and our DSCR option. So these are some of our favorite, or at least my personal favorite, non-QM options. No income or employment needed for investment properties. Simply use the estimated rents to determine a DSCR ratio. If the rents cover the expenses, that's a ratio over 1, aka the property cash flows. And we set a 3-year prepayment penalty, which is standard for these commercial type loans. Rates come in today as low as 6.125, pretty amazing. Final APR 6.436, beating conventional, still beating the alt doc option with no prepay. So pretty amazing there when DSCR comes in, beating the other options. And we can add a 5-year prepayment penalty on those DSCR options to get the rates even lower. Coming in today 5.99, final APR 6.310, beating conventional, beating the alt doc, pretty amazing. And these are some of the options we'll talk about here in a second for our condos. We also have no prepayment penalty options for DSCR, second mortgages, rehab loans, fix and flips, one-time close, commercial loans, all kinds of different options here. If you scroll down, and please get with our team members. They'd be happy to help you out. But let's get into our topic for today, which is going to be what program can we use for a non-warrantable condo. So it's a little bit hard to find. You don't necessarily know the answer to this question if a condo is warrantable or non-warrantable, but let's assume this one is. So I use this one in my last example. It's a nice condo nearby where I live here. And you can see here it might have some trouble qualifying. I'm not saying it does necessarily, but we're going to assume that it may have some issues. So here's a nice condo. Many times these older buildings, especially in Florida, where it's more restrictive, may not qualify for many reasons. But let's go over some of those reasons here. I have them all listed out on the quote example. But we'll look at this exact condo and assume that there may be something that may be non-warrantable, and we will quote it as such. So the first option here is going to be a non-warrantable condo for an investment purchase. That's our most common purchase. So if an investor wants to buy that property, rent it out, they think it's a good price. It does look like a very affordable condo compared to obviously the newer builds that will be warrantable. And we're going to use full documentation, and we can do 25% down. Now this is a Florida condo, so it is more restrictive. We may have a little higher LTV options in other parts of the country, but this is a very common example here. And it's going to be for that exact home we looked at. Now, there are many reasons a condo could be non-warrantable and not eligible, aka not eligible for traditional financing. So non-warrantable typically means that they're not following what are the standard conventional Fannie Mae guidelines for condo review. They're going to fail one or more of those check boxes that we have on the condo review. And in this case, if we're not eligible for conventional, FHA, VA, or USDA, obviously we're going to not be able to use those, and we need to go non-QM, which is why we have all these great options. But some of the reasons that may disqualify a condo from being warrantable for Fannie Mae: high investor occupancy or ownership, or single entity ownership, low owner occupancy, not many primary home people there, so that would obviously cause an issue. Short-term rentals obviously cause an issue. That gets into condotels, which will be a different topic. HOA financial issues. So this is typically the most common option that causes a condo in Florida to not be warrantable, especially as we have a lot of special assessments and things going on with the condo collapse. So a lot of the ability for these condos to receive clearance without having crazy special assessments is definitely difficult. Active HOA litigation. So many times, unfortunately, HOAs get sued. Many times that may cause it to not be eligible. New construction. So if it's not passed over, converted to owners yet, if it's still developer owned, if there's not many units sold yet, that is difficult. Insurance deficiency is another one of the most common options. So I'd say the two most common options are HOA financial issues or insurance issues, especially in Florida. If condo can't get windstorm insurance because the roof, maybe they need $1 million to repair the roof, and they can't get the special assessment to get the $1 million to repair the roof, that means they can't get the wind insurance that they need to cover that property. So many times we find insurance deficiencies. And of course, another common one, which is a little more apparent often, deferred maintenance or structural concerns. So there have been condos here in Florida that have been shuttered by the government because of structural concerns. So they're getting much more strict on those items. So we can technically go up to 88% LTV is what I put here for non-warrantable condos. But in Florida here, we're at 25% down for this exact option. So a cool option here, 6.875 rate, has 3.375 discount points at cost. 7.125 rate has 2.25 discount points in cost. So still a good option here for our investor. Obviously, this is a waterfront condo in a very popular area, so it should rent strong, which also will be our next topic, the DSCR version of this. But you see here, this is the full doc version for an investment property. We did 75% down, and we did mark it as a non-warrantable condo. So unfortunately, if a customer is denied conventional, or they already know that the property is non-warrantable, we can offer this option and still get them that property. Just maybe a little bit different LTV than they're used to if it had qualified as warrantable. Now let's talk about non-warrantable condos under DSCR. So remember, DSCR, debt service coverage ratio loans, only look at the rental income from the property. So many times if a property is non-warrantable and not able to sell to regular buyers that are looking to live there as a primary, oftentimes they do cash flow very strong. So that was my example there. This is a waterfront condo. Hopefully the rents are strong and the property is very affordable compared to other waterfront condos and high-rise buildings that are fully warrantable. And we did add a 5-year prepayment penalty here under the DSCR to get the best rate options. Other than that, the notes here are the same, and DSCR does have an actual max of 75. And we have a 5.99 rate, pretty amazing, 2.975 discount points and costs. And with the much larger rate sheet here, we actually have a 6.99 rate, giving us 0.15 lender credit back towards closing costs. And that's 25% down. And because we are under that DSCR option, we can add that prepayment penalty, which does sweeten the deal quite a bit there. So a little better option here for investor, typically, as long as the DSCR ratio is strong. If the rents are a little bit low, or things like the taxes and insurance for the actual insurance for the unit are a little bit high, perhaps the DSCR won't work. But in this case, it's a great option if it does. And the final option, not as common. Not many people necessarily purchase these as primary homes, but we can do that, of course. So here we have a 15% down payment example if we're going to purchase this as a primary home for that exact unit. And of course, there are some restrictions there, but as long as it is just non-warrantable for a pretty standard issue there, we can usually resolve it. 7.125 rate costs 2.125 discount points in costs, and we have an 8% rate, giving 0.125 back in lender credits. So again, because this is a primary, we can go a little bit lower in the down payment, that 85% loan to value, and it will still be full here as a primary. But again, this is for a customer that maybe just didn't know that the property they were under contract was non-warrantable, and we need to switch to these non-QM programs. Definitely a great option and a great deal saver for those deals that may fall through otherwise. So those are our options for non-warrantable condos. We'll be back having another episode on the condotels, which is a basically a subset of non-warrantable. So if any condo has hotel-like features, that would be a condotel, which many times you see here in Florida as well on the beach. But we have another episode about that. Those are a little more restrictive, but very similar here. Today, we're just talking about the non-warrantable condos for one of the standard reasons. So hopefully that helps out there. Hopefully our customers that are out there shopping have some luck this weekend. So get out there and make those offers. And we'll see you back next week with another episode.